Alright guys, so welcome back to the Twilight Zone. So just a week ago, the US-China trade war took a very hilarious turn. Now I don't know whether this is a comedy show or economic analysis anymore, maybe it's both. And it seems that the Trump team wants very hard to get China to reverse their tariffs, but at the same time, they keep escalating the trade war as if it even matters at this point. The Dream Team has raised tariffs on Chinese goods to a maximum of 245%, which to be honest is a joke at this point. They also re-emphasized that 75 countries are scrambling to discuss new trade deals. But the biggest economy of them all, China, is not playing ball. And this is freaking everyone from Besson all the way to Trump out. And if we look domestically within the US, things are a complete mess. If you didn't know, by cutting away Chinese products, Trump is destroying plenty of American businesses. And these are small enterprises that rely on a Chinese supply chain for affordable manufacturing. And now you amplify this to an entire state, we could see massive unemployment and an entire local economy collapsing. California, for example, is about to sue Trump to stop his tariffs, which tells us that this trade war is already facing a lot of internal resistance, and this will only build in the months ahead. Meanwhile, interest rates throughout the US are starting to rise, which is pushing this leveraged economy to the brink. At the same time, the dollar is starting to move lower and lower. We're all used to the traditional relationship between dollar strength and bond yields, but everything has changed and the rulebook doesn't seem to be working anymore. This is a big dislocation that signals the double whammy could get progressively worse. If the Trump administration continues to flip-flop or escalate things even further, we could see bond yields go up while the US dollar strength continues to collapse. And if history is any indication, we could see the dollar plunge even further down as more trust is lost. And that will do a big number on consumer confidence. The US consumer today is extremely fragile, and understand what they are facing. Trump has brought the effective tariff rate from 2.4% to over 26%. Even if exporters eat half of the amount, which I highly doubt, Americans will still face a price increase of over 10%. And that's why consumer sentiment has crashed. It's another reason why inflation expectations for the next 12 months is nearly 7%. Despite the show of force and big words, the economy itself is fracturing. Even the Federal Reserve has given up. They've essentially admitted to the world that the US economy, as a result of the tariff policy, is essentially screwed. There's no way for them to bring inflation down. Everything is now dependent on Trump and his dream team.
What yields going up indicates people are selling treasuries. And when Larry Fink, who I believe is the world's largest asset manager, spoke, he said something about the Fed might not have the ability to do any real easings. Is that what concerns you?
Well, it's not a concern. It's just a recognition of the tools that we have. So we at the Fed, we can manage kind of near-term ups and downs in the economy, but ultimately where the economy settles in the long run as a result of all of these renegotiations and these new trade flows and fiscal policy, that new normal is completely out of the central bank's control. We cannot affect that. All we can do is keep inflation expectations anchored and try to manage some of the ups and downs on that journey. But that destination is up to the executive branch and Congress, not the Fed.
In other words, the Fed can't ease the economy without destroying the dollar further. Neither can they hike interest rates without crashing everything as well. The end destination will be a result of the trade war, and the Fed is just a cleanup crew after the party. That's why we are seeing the White House in total desperation mode. Trump is demanding China to make a tariff offer to de-escalate the trade war that he himself started. He wants Beijing to give him a call to start the negotiations so that he will look like a winner. Now this is really bizarre and shows us how the need to win is clouding his judgment, because the longer this drags on, the worse it will be for everything. Inflation, the stock market, US bonds, mortgage rates, all these will be victims of the trade war. But within the demand is yet a tinge of arrogance in the follow-up statement that Trump demanded Levitt to say as well. It's a sign that a bigger collapse is needed for the US to capitulate.
Look, the president has made his position on China quite clear, although I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants what we have, the American consumer. Or to put it another way, they need our money. So the president, again, has made it quite clear that he's open to a deal with China, but China needs to make a deal with the United States of America.
China, on the other hand, is not in a hurry at all. Their boycott of Boeing planes and the 125% counter tariff, it's a sign that they're going to duke it out until the end. Chinese officials have indicated that talks are possible, but the Trump team has to stop all the disparaging remarks. We all know what they're referring to, particularly JD Vance calling Chinese people peasants. So all that buffoonery has to stop if Trump really wants a dialogue going forward. Beijing is not going to budge because they hold a much stronger hand than what Trump thinks. And if you look at the markets, it's really obvious what investors are thinking. According to Bank of America, global investors have the worst outlook for the US economy in 30 years. A record number of them wants to pull out of the US stock market. Additionally, this negativity isn't fully priced in yet, so there could be more downsides to go in the weeks ahead. It's even crazier when you have the Secretary of the Treasury trying to dance around the fact of the markets collapsing. It's crazy because this man is a billionaire. He's a hedge fund manager or was a hedge fund manager, and he should know better.
Now, I forget what they hit on Friday, maybe 440 something.
We saw a 50 basis move last week in 10-year yield. At the same time, the dollar was weakening nearly 3%. How do you simultaneously look at that situation? It feels like investors are dumping U.S. assets.
Well, look, I've learned that not to look at what happens over a week. Right? I, for better or worse, have lived through a lot of these things, and in trading, in one's personal trading history, it's the scar tissue that sticks with you the most. I can tell you exactly where I was standing in 1998 when the long-term capital, the debacle happened. That had nothing to do with anything other than a bunch of geniuses up in Greenwich who had too much leverage.
Once again, he didn't give us a proper answer. It's a classic deflection. When he can't tell people the truth, someone out there is selling all those treasury bonds and equities. That's why the market is going down. What does long-term capital have to do with the trade war today? It's two completely different issues. There's still a big sense of denial within Washington that this can't be happening to us. And this is a very dangerous sentiment to have. While the US economy is in deep trouble, data coming out of China is actually quite promising. It tells us that the tariff war might actually be benefiting Beijing instead of collapsing the country. Now, firstly, Chinese exports have been rising higher ahead of the US tariff war. Exports in March were up by almost 6% from a year earlier, and that is surpassing a very high bar. Nearly $1 trillion worth of goods were sold to the world. People were buying affordable goods hand over fist because the trade war really started in April. They could literally see it down the road. And we could see this buying from the rest of the world escalate even after Trump's 245% tariff on China now. Yes, the new effective rate is up to 245%. And when Trump decided to slap the world with a baseline tariff of just 10%, which could escalate again, this reduces economic growth for the world. And when your consumption power drops, you need more affordable goods to fit your budget. Once again, this plays into the hands of China. People would be hyper-focused on value, and the last thing they will buy are US-made products that cost more. And to keep up the momentum of their exports, China is pulling hard on the currency trigger. They are moving to stockpile a lot of wealth for the long trade war against the United States. China has decided to let the yuan weaken even further than we expected. China's central bank has set the exchange rate to 7.21 against the dollar, the weakest peg since September 2023. It's mighty clear that Beijing doesn't want to lose their export market just yet. The US tariffs means Chinese goods can't enter the US anymore, so a weaker RMB helps to make their exports cheaper to the world. And if we look at the RMB versus the euro, we can also see the same trend. The Chinese currency is now at the cheapest level since 2014 versus the euro currency. It's obvious that China wants to fill in America's shortfall with European demand, especially if the EU gets hit with a 20% tariff. They will need cheaper inputs to drive their cost of production down. It's also the same reason why President Xi went all the way to Southeast Asia a few days back. This region plus Europe will be the big new growth drivers. The EU is breaking their fiscal limits, so government spending is going to go up. Asia has always been a reliable growth engine, so Chinese exports to that region will also increase. But why is China doing that? Well, China is simply hoarding more trade surplus today to fight a longer trade war with the US. In Q1, China's trade surplus still clocked an incredible $273 billion, and that's 12.4% higher from a year earlier. The agenda here is to stockpile as much wealth as possible because China eventually has to crank up domestic spending to hit their 5% GDP target. Now, GDP came in at 5.4% in Q1, which beat all expectations. But to stay at that level, China will have to unleash the stimulus, and they can either do that with their trade surplus or just borrowing endless amounts of money like the US, which they don't want. By playing the currency card, China is piling up even more trade surplus and would likely use it to boost their domestic economy, especially if the global sentiment, everyone in the world, global consumers, they all fall into recession. Now we can already see this taking effect in Chinese retail sales. Beijing's trading program is getting a ton of people to spend, spend, and spend. We are seeing double-digit growth rates over the last quarter in furniture, smartphones, and household appliances. And the bigger trade surplus gives the government the fiscal buffer to fund all these stimulus programs. It increases tax revenue and allows the PBOC to lower interest rates for a very long time. When you have excess liquidity from your trade surplus, you don't need to hit the reverse gear to tighten the economy. If China needs to strengthen the RMB, they don't need to raise interest rates. They can simply sell off their surplus of dollars. So China's currency play is a direct signal that they are willing to play the long game with the US. They won't fold like a cheap suit and let Trump take the win. For Washington, they have to really ask themselves, how much more pain can they endure? What is our pain threshold? Because this just feels like the plan to contain Russia all over again, and we know who won that one. Meanwhile, America's own tariffs are going to put pressure on its own economy. There's a reason why Trump wrote back and gave a ton of exemptions is because the US relies on more than just consumer goods like plastic toys from China. This chart shows us that China exports a lot of advanced technology to the US that would be hard to source from other countries. US exports to China are mainly less complex. These are mainly fuel exports including LNG and food produce as well. China, on the other hand, exports a ton of high-value technology to the US, including semiconductors. If China ramps up the pain by proactively banning all these exports, many US industries won't be able to reshore. The cost of everything from computers to making an EV will just soar in price. And don't think China won't do it. The Wall Street Journal has confirmed Besant's final agenda, as we knew all along, was to contain the Chinese economy. Besant wants US trading partners to limit China's involvement in their economies in exchange for tariff concessions. And this opens up a whole can of worms. Does Besant want them to raise their own trade barriers, to impose import quotas on Chinese goods, or prevent Chinese investments from entering, or maybe all of the above? And whatever the plan is, we are moving closer towards a bifurcated world. Trump wants the global economy to choose between the US and China. However, I don't think he will like the end result. But let me know what you think. Will China bend to Trump's demands? And what is Beijing's next move in this trade war? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.